Hi, everybody, and Happy New Year. Welcome to 2025. I'm Philip Nelson and joined by a distinguished group from our asset allocation effort, Jen Appel, Robert Goldthorpe, and James Riker. And we are excited to share our outlook for 2025 and provide some detail on what are some of the key themes that we see playing out over the course of the year. This is something that we, publish every year. It's always a really exciting thing for us to unveil these and really chat with, all of our team members internally and also, all of our clients over the course of the next several weeks. So we're looking forward to all the great discussions that are coming. And with that, why don't we get started right off the bat? And Jen, do you want to share kind of high level what our outlook for 2025 is?
Sure. Thanks, Phil. As we think about 2025, I kind of want to take a step back first and think about where we came from in 2024, where we had another year of really resilient economic growth in the US and outsized market returns, especially for a lot of risk assets around the world. And so as we look at really the last couple of years, a lot of the same things have worked and have a lot of momentum behind them. So as we come into 2025, here we are with really high sentiment across markets, especially in US equities, which I'm sure we're going to talk a lot about today. And valuations are still pretty expensive. So it's a little bit of a balance where, we don't want to necessarily say that we're in a bubble or that this time is different or throw out some of those terms, but we also don't want to be scared of equities at the same time, given some of the tailwinds in markets today. And then just thinking a little bit more broadly from an inflation standpoint, inflation was really a big story the last few years. What we saw as of late is that inflation pressures have been moderating, but we're still stuck at a little bit stickier levels. So I think that path for inflation in 2025 has a little bit of uncertainty around it. That's going to inform also how quickly the Fed can cut, because that does appear still to be their bias coming into this year. So that's really the high level backdrop for what we have today. But I think a lot of uncertainty around some policy or geopolitical aspects that can add some fuel to different fires in the economy.
Yeah, no, I think that's really well said, and it's a challenging environment because there's seemingly not kind of clear investment opportunities that are kind of ripe for the picking that we can easily grab. It's a more challenging environment. I think if anything, thinking about our portfolios and our clients' portfolios in terms of, let's be as close as we can to our strategic targets. And in some cases, maybe this is a year to be a little bit boring and just reviewing policy targets, reviewing your investment policy benchmarks, things that might spend time on over the course of the next year to take up meeting time to some degree to kind of just keep the house nice and tidy. Because markets might be a bit of a challenge over the next year, especially when it's hard to find anything that we would call so-called cheap, because it's a relatively expensive market across the board, with the exception of maybe interest rates. But even then, it's not clear to say that rates are cheap at this present point. Maybe as we think about one of the other kind of big issues at play today, kind of Jen, you mentioned this, kind of just dealing with the Fed and what the Fed may do. There's a little bit of a sense of, is the Fed hesitant, or does the Fed have a clear understanding of where they want to be over the course of the next several months, let alone the course of the next 12 months? There's a fair amount of policy uncertainty that seems to be creeping into their views, which is flowing into the market. Wonder if you all have any thoughts on kind of the Fed and the outlook there.
Yeah, I think you're right. There has been a lot of kind of uncertainty around what the Fed's next steps will be over the course of the last 4 or 5 months, and now it does seem that the most recent minutes, some of the participants are starting to include potential impacts for tariffs that we still have not quite understood what that might look like. So how the Fed starts to incorporate what actually transpires into their forecasts will be something to keep an eye on for the rest of this year. But it's notable that we went into last year assuming there would be significant cuts throughout the year, and that never materialized. We come into this year, and the market now thinks that there's really not going to be that many cuts as we go through this year. And we've had a really strong economy. And so in a lot of ways, if the economy stays strong, maybe there isn't a need to make monetary policy any easier. And the restrictive levels that we're at right now are still supporting robust GDP growth. So why not keep the rates higher? And I think, that environment is one that we see in front of us right now. Right now, the markets only expect just over one cut in all of 2025. And that could create a situation, to Phil's point, where maybe treasuries or interest rates look a little cheap. We saw rates go up over 5% at the long end this week, and that could entice some buyers. So it certainly will be a volatile market throughout the year as we watch not only the Fed at the front end, but also inflation and growth as it impacts the back end and real rates.
Just to add to that, I think the December FOMC Fed governor meeting was kind of the first time we saw some dissent among voting members in terms of whether or not an interest rate cut was needed or not. I think 4 members voted to keep rates level, where everyone else voted to cut 25 basis points. So this is the first time we haven't seen a total consensus among Fed governor, at least voting members, on whether or not to, in terms of interest rate policy. So I think that's going to be an interesting dynamic throughout this year. There's starting to be at least some disagreement. The market, Fed, us, NEPC, in terms of whether Fed cuts are needed this year or not.
And one of the aspects that we've discussed internally too is that from the September Fed meeting to the December Fed meeting, there wasn't actually a whole lot that really changed in terms of the economic data that we got, but we did see a pretty big shift in Fed expectations. And I think that is a reaction to some of the policy implications with a second Trump administration coming into office. So it seems like a little bit of speculation almost from the Fed kind of crept its way through the dot plot, which is a weird dynamic for us to react to.
Yeah, this might not be a fair comment, but it almost appears like the Fed is a bit spooked, where they raised their inflation expectations, by fairly decent amount without any new real kind of economic data informing that, but they still cut rates in December. So those don't really reconcile. So there's something else going on. Likely is they're accounting for, or kind of viewing, the new administration, Trump administration policies likely to be somewhat more inflationary. But the Fed also says they only act on data. They don't speculate. So, there's definitely some question marks as we start 2025. And I think many of us have some big questions for the Fed, which will certainly get answered over the course of this next year. With that, you wanted to highlight some of the major themes that we see coming in 2025. Part of that is, here we'll give a little bit of a preview for them. But over the course of this year, you'll hear a lot more detail on these items, because we think they will have a big impact on markets and be quite relevant in terms of impact in capital markets, economic behavior, and even just sentiment. And so the 4 major themes that we see for 2025 revolve around a couple different issues. One is kind of just looking at tariffs and trying to understand what does a higher tariff policy mean for the global economy. So thinking about how do we explain tariffs explained in better detail, because there's a nuance that often gets lost with many of the headlines that we see today. So we're going to be spending some time with that over the course of this next year. Also, AI spending. We talked about AI last year. Clearly, AI is a dynamic and force that's likely here to stay, and still questions of what's the productivity benefit, what degree of job replacement does or job productivity does AI add for the workforce. But spending from AI is a huge market force, whether that's coming from the top 10 names in the S&P in terms of their capital expenditures, whether that's data center growth, and then you'll hear from our real assets team also over the course of this year, how does data center growth reconcile with power consumption in the US? There's some governors here in terms of does the country produce enough electricity to run some of these data centers? And also, similar to last year, we had a geopolitical theme, and this year, continuing with that, of just kind of a focus on world affairs. The world is seemingly more volatile. We have a lot of changes in administrations across the world in terms of ruling governments. Here in the U.S., moving from Democrat to Republican government. We saw that in the UK last year. We've got some major elections coming for France and Germany and Canada over the course of the next 12 months. Not to mention what are kind of US and China relations and how that may change over the course of the next year. And then the last piece that is less of a kind of pure investment view, but more of just an observation that there's some real pockets of euphoria that have built into markets. Some areas you call micro bubbles. It's hard to say there's a broad bubble across the entire kind of capital market complex, but there's clearly some areas of kind of excess that have built up. And so this idea of kind of pockets of euphoria is something we talk about a lot, especially as sentiment stays high in some areas. And you're seeing some of that break down even the first 10 days of the year. But there's just some interesting data points that we can highlight. For example, the total value of cryptocurrencies is greater than the value of all of the gold held by central banks. That is what you do with that information is hard to say. It's not just saying it's not an investment recommendation or an action, but it's an observation. There's something going on in the markets that's driving some of this positive sentiment and momentum, and spending some time this year thinking about that as well. So I wonder if any of you had any thoughts, comments on these big themes we're going to be spending time with over the next year.
Yeah, maybe if I could just comment on some of the things you mentioned on the tariff front, but also on the geopolitical front as well. I think what we've seen over like the last year or so is that markets are really reactive to these things, number one, but secondly, they're very quick to price in all of these negative outcomes associated with what we might consider to be more tail risk items. And on the tariff front, I'm not trying to suggest that those are tail risks, but I think some of the points you mentioned around all the nuances around tariffs are really important because, first it's if we get tariffs, secondly, it's when they happen, the scope, the rates, and so forth. So there's a whole slew of things that will determine how impactful they are for growth, for inflation, and for sentiment as well. But of course, the market's really sensitive to tweets and news flow around tariffs overall.
One of the, I think, kind of key items of focus we've had of this last year is how do we think about building an equity portfolio, implementing an equity portfolio, but also thinking about long-term with our capital market assumptions. What are the fundamental building blocks associated with equities, maybe in this case specifically S&P 500, and how are we thinking about those fundamental sources of return evolving, maybe in our minds and our models? And Rob, I wonder if you could spend some time with that and discuss.
Sure. So if you think about, let's say S&P 500, and trying to predict a return for that for the next 10 or 30 years, it's really about how fast their earnings going to grow and what price is the market going to pay for those earnings 10, 30 years from now. And then you can add, I guess, a dividend on that for total return purposes. But essentially, it's what are earnings going to grow at and what price the market's going to pay for those. Those two things have kind of been beating our expectations, not over the last few years, but almost decade post kind of GFC. And I think I guess most market purveyors expectations for especially the S&P 500. So there's been this underestimation of what the top 500 stocks in the U.S. are going to return. So, we've been looking at our models. I think we're trying to predict the future here, which isn't always easy, obviously. And we're talking about investments, which have risk, range of outcomes, all those types of things. And we're trying to make assumptions about what are the underlying building blocks of return going to do over the future, and not just, if we had a backward looking model, we can just plug in historical figures and output you a return. But that's not what we're trying to do. We're trying to predict what's going to happen over the future. So that requires us, analyzing not historical data, yes, but thinking about how's that going to develop through the future and change, and how do those things interact. So how are earnings going to grow? What are valuations going to be? And are there other aspects of total return that we aren't, I guess, entirely valuing? And one of those might be share repurchases, especially within the S&P 500. You look at the top 10 names, Magnificent Seven, the word that gets thrown around is hyperscale, right? These companies, high margins, they scale really well to not only the US economy, but the global economy. And an aspect of returning kind of capital to shareholders is less so through dividends, but more so through kind of share buyback programs. That's something we've kind of implicitly valued in the past. But I think with this iteration of capital market assumptions that's going to come out for 2025, it's something we're starting to explicitly model in our equity models. So that's one piece. It's also kind of something we've been phasing in, speaking of that hyperscaling, high margin type of story with the S&P 500, is kind of phasing in higher valuations and high margins. And to what extent are those sustainable through time? They have been sustainable over the past, almost decade. I think that's something we've been phasing in. And with this iteration, we've kind of pulled forward future iterations and kind of kind of phase it all in at once with this iteration. So if you look at our assumptions this quarter relative to the last quarter, you might see a 150 basis point jump in US large cap kind of 10-year return. A lot of that is kind of pulling forward future phasing in of some of those building blocks all in today, which kind of speaks to, I think, what Jen might touch on is kind of what we see within the equity complex in terms of strategic kind of asset allocation, equities globally.
Yeah, and I think what's interesting about that, Rob, is as you said, it's a bit of not quite a reset, but it's an update that's getting kind of pushed through our assumptions. And at the core of it, we've looked at profit margins we think are more sustainable at slightly higher levels in the future, which that has a lot of broad implications. It allows a lot of companies to be able to sustain higher buybacks. It makes a higher valuation multiple more appropriate and internally consistent when you think about a return on equity type model and valuation structure. And I think also one of the things that we spent a lot of time talking about over the course of this last year also is to what extent are US markets special? And there's a bit of a specialization or uniqueness that we've applied to US equities, deservedly so, but specifically to US large caps, that's flowing through some of our kind of long-term strategic thoughts as well.
Yeah, I think, just to add to some of the comments Rob and Phil made, if you think about the way the US large cap landscape has changed over the course of the last few decades, we've moved from a index that had some tech in it, but had a lot of other diversifying sectors near the top of the cap charts. Over time, as US consumption has just grown so much, and what US consumers consume is often services or tech-related services. So you can very clearly see how companies like Apple and Google and Microsoft got bigger, but are likely to continue to be bigger as this consumption pattern is likely to continue as long as everyone has jobs. And so one of Rob's points was that, you've got higher margin industries or higher margin companies inside of a lot of tech industries. And simply as that becomes a bigger part of the US consumption story, which is already a larger part of the US, or excuse me, the global market cap, it makes these margins more sustainable in the absence of any competition coming in to compete those margins away. Rob used the term hyperscalers. It's really hard to compete against some of those Apples and Googles of the world. And so one of the risks to this thesis might be a regulatory environment that, goes the other way and does not, allow, the hyperscalers to continue to exist in their scale. We view that as a low risk event over the course of, the next handful of years. And so that gives us some confidence in leaning into a little bit more of these slightly higher margin numbers relative to history and their sustainability over the course of the coming market cycle.
And with that, Jen, maybe you can kind of briefly touch on what are the implications of some of these capital market assumption changes, and also maybe highlight how we've adjusted kind of our long-term strategic view for global equities in terms of through an implementation lens.
Yeah, sure. So our current strategic equity guidance is recommending first that everyone be benchmarked to the MSCI All Country World Index or the ACWI IMI Index. And to use that as your strategic policy benchmark for performance reporting purposes and so forth. So that's really the starting point. And then with that in mind, we're recommending being aligned with benchmark neutral regional weights for the index. So that is a little bit different than what we've had before. And I'll talk through just quickly some of the differences. But as was kind of highlighted so far, the weights in the global equity complex have moved a lot over the last 6 to 12 months with some of these dynamics that we've mentioned. So today that weight looks like 66% US, roughly 24% non-US developed, and 10% emerging markets exposure. So I think off the bat, you'll notice that that's a relatively smaller weight to emerging markets than we've had in the past. Previously, we had a recommendation based on a thesis around growing consumption in China and Asia more broadly. We, over the last couple of years, I think have pushed back on that a little bit, given a lot of the top-down issues that China's battling, which are weighing on sentiment and market fundamentals as well. So that we think justifies kind of that 10% index weight that's there today. Then on the US side, just since that's where really the bigger changes coming into play, you heard a lot of comments from the rest of the team here about why we think US markets are kind of special, as I think we've put it, but we think there are some structural factors at play for US markets that can support that even elevated weight that's in the index today, even against a backdrop of elevated valuation. So we think that those benchmark neutral regional weights make sense. And then the last thing I'll just mention on this is that since we are recommending that benchmark neutral positioning, we do think that puts greater emphasis on other active decisions that are made in the portfolio, whether that's adding in some current opportunities or using active management. Those are some other levers that you can pull to add to returns and to introduce alpha and really enhance returns relative to the ACWI IMI benchmark. So I think that's our broad recommendation for the equity landscape.
Great. Thanks, Jen. That's a great run through of those updates. Maybe to pivot to fixed income. Over the course of just the first week or so of the year, we've seen interest rates rise a fair amount, and since the Fed started cutting rates in September, we've seen a very significant rise in long-term interest rates. I want to just briefly kind of talk through any implications that we see as U.S. rates approach 5%, or in some cases exceed 5%, especially at the kind of very long end of the bond market. So any thoughts there?
Yeah, I touched on this already a little bit. The 5% level on, the long end is certainly interesting. We hit there at kind of the 20-year point and beyond yesterday. We're doing this on January 10th here. So by the time you see it, we might be 5% from 10 years and beyond. It does seem that the moves are for the market to expect rates to maybe move a little bit higher. I think 5.25 is a number that wouldn't be unreasonable, but I don't think our views are that we'll see a 6% level, on the 10-year or beyond. I think if you do, then you do start to see some risks to the potential for upside equity valuation in that environment. Thinking back to 2022, when we had kind of surprise increases in yields that were bigger than expected, that wasn't a great environment for equities. But I think the 5% level that we're at right now, is one that's teetering on the verge of almost looking attractive. If you think that we are in a moderating inflationary environment, inflation numbers have been sticky, but they're still better than they were 12 or 24 months ago. So if that does continue to moderate, this could be an interesting time to be a buyer of these yields. One point I'll make is when you look at real yields, so the yield underneath treasuries and tips, that's a 2.3% today, and that's a really attractive longer-term level, especially when we've been in a world where it wasn't too long ago that we were at zero and negative in this space. So that provides a lot of potential downside protection should you start to see some negative outcomes. So hedging for the worst case scenario is not quite as punitive to investors anymore. So a little bit more attractive on the long end. At the same time, if the Fed does stay slower and the front end stays higher, the consumer credit concerns will start to come in, but we're not there yet. There is not the volume of consumer credit like we saw pre-global financial crisis. And there's two big reasons for that. One, you don't have the same kind of pain as it relates to mortgage credit. There's less subprime loan, and a lot of borrowers are locked in, at very low rates. And then also student loan defaults are a thing of the past with a lot of the moratoriums over the course of the last few years. That'll be something to keep an eye on as it relates to kind of credit concerns. But overall, the 5% level isn't something we're really too worried about. In fact, it could present some interesting opportunities, and a moderating front end should be supportive to not only consumer credit, but also lower quality corporates who use the bank loan space to finance some of their growth. So moderating, we think, is the path forward here, despite the back end maybe staying a little bit higher.
And I think for some that maybe don't have any tips exposure or relatively low tips exposure, this is kind of good timing to kind of introduce that into portfolios. Because as you mentioned, real rates are much higher than they've been over the last several years, and more than fairly valued and appropriate for kind of this level of economic growth. And we think it's a great kind of diversifier to look to over the course of this year. Well, maybe as we wrap up, maybe just kind of go around the table briefly, and just any predictions, thoughts for 2025 that you'd like to share.
So James just mentioned, rates nearing 5%, and I think the 10-year can honestly get to 6% or higher this year. If not this year, maybe next year. And that's not necessarily an anti-equity story either. That's a nominal growth kind of story with deficit levels and just growth, just consistently coming in at 5, 6, 7% nominal.
I've been thinking a lot about currencies this year, and I think there's a consensus out there that the dollar will stay strong and or strengthen from here, given some of the policy backdrop that we talked about today. I am a little skeptical of that, and I want to be clear, I think it's just going to be an incredibly volatile year for currencies. Some of it's because of geopolitics, but we're also seeing a lot more divergence around the world in terms of growth and inflation rates that could drive some volatility in currency pairs. So maybe a note of caution to be mindful about unhedged currency exposure in your portfolios if you got it.
I predict that CCC credit spreads will get below 400 basis points before they turn.
Not in the year below 400, but some point during the year they'll be below 400.
That's right. And that would be historic, right? That would be approaching historic lows. And I say it mainly because most of 2024, folks were saying credit spreads are tight, it's really bad, and then high yield had a great year. I think we come into this year and everybody looks around and they say, wow, yields are pretty good. Maybe I want to own that. And I think you do still have some animal spirits around wanting to own, high single digit yields, which will keep this kind of risk on movement going, at least for the first half of this year. And I think we'll certainly test some all-time lows in credit spreads before and if it turns in 25.
Yeah, I think an easy prediction to jump on that is, just thinking about most calendar years, you have some sort of equity correction. We haven't seen it as much the last couple of years, but there's a good chance we'll see at some point, a 10% drawdown, let's say S&P 500. That's an easy prediction to make, but I think maybe what's more important is we look at underlying earnings growth for S&P 5. It's actually still quite strong. And so I think there's plenty of reasons to believe S&P will, and kind of diversified large cap equity exposure, and I'm thinking about value and quality factors mixed with S&P, will actually do quite well over the course of this next year, even if we see kind of interest rates rising, but maybe we also see rates rising with the Fed cutting a bit more than the market expects. We could see more than 2 cuts, especially if inflation is relatively stable as it looked to be, back in September. But again, we spent a lot of time, and the team here has spent a lot of effort over the last several months, reshaping our views, thinking about, what are the implications for the markets in 2025. So we're really excited to share these themes and our outlook, and look forward to more discussions over the course of the year. So thank you all, and hopefully enjoyed listening.